If you bought silver this morning because you saw those headlines, man, I've got some brutal news for you. You just became the exit liquidity. You got played, straight up. Yesterday, the financial world was absolutely buzzing with one of the most insane bullish reports we've ever seen. Bank of America, one of the biggest financial institutions on the freaking planet, dropped a research note predicting that silver could skyrocket to $300 an ounce. No joke. It was literally everywhere. Twitter, news blogs, your inbox, everywhere. Retail investors saw that number, $300, and they totally panicked. They thought, I gotta get in right now before this thing goes to the moon. So this morning, Wednesday, January 7th, they rushed in like crazy. They pushed the price of silver all the way up to $32.75. It looked like a massive breakout, man. It looked like the start of the run to triple digits. And then boom, the trap snapped shut. Right at the exact moment the euphoria hit its peak, a massive wave of selling slammed the market. The price didn't just stop, it straight up collapsed. We're now trading at $28.54, down $2.62 on the day. That's a drop of more than 3%. If you bought the high at $32, you're already down 5% in a single afternoon, dude. This is a textbook financial maneuver known as selling the news. The smart money used that bullish headline to dump their positions onto the dumb money who chased the hype. In this emergency market breakdown, we're going to dissect exactly what went down today. We're gonna explain why major banks issue these crazy bullish forecasts right at the top of a trading range. We're going to look at the double top that just formed on the chart, a seriously dangerous technical signal that suggests we might have further to fall. And we're going to tell you how to survive this insane volatility without losing your position. The headline said $300. The chart says $28. You need to know which one to believe. This is the story of the Wednesday flush. To understand today's crash, you got to understand how a whale exits a trade. Imagine you're a hedge fund manager. You bought millions of ounces of silver at $20. Now the price is $30. You've got a massive profit. You want to sell, but you've got a serious problem. If you just hit that sell button, your order is so freaking big that it'll crash the market before you can even get out. You need buyers, millions of buyers to step up and take your bags. How do you find millions of buyers? You need a headline. You need a story so exciting that retail investors rush in without even thinking. Enter the Bank of America report, silver to $300. Whether by coincidence or design, this report provided the perfect liquidity event. When the retail herd read that headline, they flooded the market with buy orders. They created a massive wall of liquidity at $32. And the hedge fund said, thank you very much. They sold into that strength, sold into the greed. They used the retail buying pressure to absorb their selling pressure. This is exactly why the price crashed the moment the news went viral. The smart money was distributing their shares to the late money. It's a tale as old as markets themselves. Buy the rumor, sell the news. The rumor was the breakout, the news was the target, and the result was the crash. Now let's look at the technical damage. Charts have memory. Traders remember where they lost money before. Look at the chart from last week. On December 29th, during Ghost Week, silver spiked to $33.71 before crashing hard. That was the first rejection. Today, January 7th, we rallied to $32.75 and got rejected again. We failed to break the old high. In technical analysis, this is called a double top. It looks like the letter M. It's a bearish reversal pattern, man. It tells us that there are aggressive sellers defending that $33 level. Every single time we get close to it, they step in and smash the price down. This creates a ceiling. Until we break $33.71 decisively, the breakout is on hold. We're stuck in a range. The top of the range is 33. The bottom of the range, well, we're about to find out. We also got to look at the leader, gold. Gold is trading at $2,653, down $32 today. While silver's down 3%, gold is down nearly 1%. This tells us the selling is broad-based. It isn't just a silver problem. It's a precious metals problem. Why is gold down? Likely because of the bond market. Yields ticked up slightly today. When yields go up, paper gold gets sold. And when gold gets sold, silver gets sold 3 times harder. That's the high beta curse, dude. On the way up, silver's a rocket. On the way down, it's a rock. But notice something super important. Gold is still holding the $2,600 level. It's not collapsed. It's just consolidating. This suggests that today's move in silver was a total exaggeration. Silver overreacted to the downside, just like it overreacted to the upside this morning. It's like an emotional teenager reacting to the steady parent that is gold. The parent's fine. The teenager's just having a mood swing. We need to discuss the psychology of a $300 price target. When a bank like Bank of America puts out a number like that, they're talking about a long-term forecast. They're talking about 2026 or 2027, but the retail investor reads the headline and thinks it means today. They think it's going to $300 by Friday, man. This mismatch in time horizons is exactly what causes the losses. The bank analyst is looking at a supply deficit that'll take years to play out. The day trader is looking at a 1-minute chart. The day trader buys the long-term forecast with short-term capital, and when the price drops $2, they get stopped out. You gotta align your timeline with the thesis. If you believe silver's going to $300 because of a structural shortage, then what does a $2 drop on a Wednesday even matter? It doesn't. It's just noise. But if you're trading with 20 times leverage trying to catch a breakout, it destroys you. Today was a brutal lesson in time frame management. The destination might be $300, but the road there is full of potholes. But let's not dismiss the report entirely. The fact that Bank of America, a bank historically known for being short on precious metals, is now publishing bullish targets, that's a massive signal. It means the narrative is changing at the institutional level. In the next section, we're going to dive into the Bank of America report. We're going to look at why they raised their target, analyze their comments on solar demand and mining supply. And we're going to ask the big question, is Bank of America trying to trap you, or are they signaling that they flipped their position from short to long? The pump might be fake, but the pivot is real. We're reading the fine print. If you're just joining us, we've analyzed the trap. We saw the price rip to $33 on a headline and then collapse to $28 on the reality. But we need to go back to the source of the explosion. We need to talk about the headline itself, silver to $300. This wasn't some prediction from a YouTuber. It wasn't a random post on Reddit. It came from Bank of America Global Research. In the precious metals community, Bank of America is known as the Death Star. For years, they held one of the largest derivative short positions in history. They were the hammer that kept the price down. They told their clients that silver was a waste of time, told them it was just an industrial byproduct. But yesterday, the Death Star fired its laser in the opposite direction. They released a report that didn't just upgrade silver, it repriced the entire asset class. They said that in a bull case scenario, silver could top out at $300 an ounce in 2026. In part 2 of this investigation, we're going to tear apart that report. We're gonna now look at why the biggest bear on Wall Street just turned into the biggest bull. We're going to explain why this pivot is more important than today's price drop. And we're gonna now show you why this report acts as a permission slip for the dollar. 50 trillion of pension capital waiting on the sidelines. The price action was ugly, but the fundamental signal was beautiful. Let's look at the report. The report was written by Michael Whitmer, the commodity strategist at Bank of America. He's not some fringe analyst. He speaks to the largest money managers in the world. And in this note, He admitted three things that the banking cartel has denied for decades. Admission 1: supply is inelastic. The report acknowledges that miners can't simply turn on the tap. They admitted that even if prices rise, mine supply will remain flat or falling for years. This kills the bear case that higher prices will fix the shortage. They admitted the shortage is structural. Admission 2: solar demand is unstoppable. For years, banks said that solar panels would just drift away from silver, said engineers would replace it with copper. Bank of America just admitted that this is totally false. They project that the green transition will consume silver faster than we can dig it up. They validated this scenario we've been talking about for weeks. Admission 3: the monetary premium. They linked the price of silver not just to industry, but to gold. They said that as gold breaks out to $2,700, silver must follow to maintain the ratio. They admitted that silver is money, dude. This is a total capitulation. It's the financial equivalent of a general surrendering his sword. The bank that fought the hardest against silver has just admitted that the math is undeniable. So the narrative's bullish. The banks have flipped. The institutions are coming. But we still gotta deal with the ugly red candle on the chart. We gotta deal with the fact that we're trading at $28. And technical analysis doesn't care about Bank of America reports. It cares about price action. In part 3, we're gonna look at the technical damage. We're gonna analyze the double top at $33. Look at the support levels that must hold tomorrow to prevent a deeper correction. And we're gonna answer the question, is the trend broken? We need to know if this is a bear trap or a trend reversal. The charts hold the answer. We've analyzed the psychology of the sell the news event. We've exposed the Bank of America, flip-flop from short to long. But now we gotta deal with the cold hard reality of the chart. If you're a technical trader, looking at the silver chart today makes you nauseous, man. We just printed a massive red candle. We failed to hold the $30 level, and we formed a structure that looks suspiciously like a double top. In part 3 of this emergency breakdown, we're going to put aside the conspiracy theories and look strictly at the price action. I'm going to explain why the rejection at $33 is a serious technical warning sign. I'm going to map out the kill zone between $25 and $28, the area where the bulls must step in to save the trend. And I'm going to show you why, despite the ugly daily candle, the weekly structure suggests this is a bear trap designed to steal your shares before the real move to $50 begins. The chart's broken in the short term, but it's building a monster in the long term. Let's look at the lines. Let's be honest about what the bears are seeing. On December 29th, we hit $33.71 and crashed. Today, January 7th, we hit $32.75 and crashed. This created two distinct peaks. In technical analysis, this is the classic M-top or double top pattern. It suggests that buyers are exhausted, suggests that there's a massive supply of silver for sale above $32, and the market doesn't have enough money to chew through it. If this pattern plays out the way the textbooks say, the price should retreat all the way back to the neckline. Where's the neckline? $20. That's a long way down from here, man. That's why you're seeing panic on social media. The technicians are screaming sell because the pattern says we're going lower. But here's the catch. In a supercycle driven by inflation and shortage, technical patterns often fail. A double top often turns into a high handle. Instead of crashing to $20, the price simply goes sideways. It flags. It digests the supply. And then when the sellers run out of ammo, it rips through the double top like it wasn't even there. I believe we're forming a handle, not a top. Why? Because of the volume. Look at the volume on the sell-off today. Yeah, it was high. But was it panic high? Nah, it was profit-taking high. It matched the volume on the way up. Now look at the bid support. Every time the price dipped to $28.40, it bounced. We're trading at $28.54 right now. We're not crashing through the floor. we're sitting on it. This tells us that there are passive buyers sitting at $28. These are the institutions we talked about, the pension funds. They didn't chase the price at $32. They waited. They let the traders flush the price down to them. And now they're quietly accumulating millions of ounces at the discount. When you see high volume but sticky price refusing to go lower, it means accumulation. The metal's changing hands. The weak hands are giving it to the strong hands, and strong hands don't sell. They hold for the next leg. So where's the line in the sand? Where does the trend officially break? The fortress is built between $25 and $28. $28. This is the immediate support. It was the breakout level from earlier in the week. If we hold this, the bull market is incredibly strong. Means we didn't even need to retest the lower levels. $25. This is the major support. This was the ceiling for all of December. Remember the rule, old resistance becomes new support. If the price falls to $25, it should bounce hard. The entire market's watching that number. Banks, algos, and stackers all have buy orders sitting at $25. If we break below $25, then we got a problem. That would invalidate the breakout. It'd be a failed move. But right now, we're more than $3 above that danger zone. We've got a massive buffer. So don't let a 3% drop scare you when you've got a 20% cushion. Let's look at the RSI, Relative Strength Index. Yesterday, the RSI on the daily chart was pushing 80. That's overbought. Means the engine was running too hot. It needed to cool down. Today's crash accomplished that mission. The RSI has dropped back into the 60s. This is healthy, dude. You can't run a marathon at a sprint pace. You gotta slow down, drink water, catch your breath. The market's catching its breath by resetting the RSI without destroying the price trend. The market has recharged its battery. It now has the energy to make another run at $33 next week. If we had kept going straight up today, we would have crashed harder tomorrow. So in a weird way, today's drop saved the rally. It prevented a blow-off top and replaced it with a consolidation. Consolidations are boring, but they're sustainable. We need to check on gold again. The gold to silver ratio widened slightly today. It went from 56 back to 57. This makes silver cheaper relative to gold than it was yesterday. This attracts the value buyers. The algorithms that trade the ratio will step in to buy silver and sell gold to close the spread. So gold's acting as the anchor. It's preventing silver from drifting out to sea. I want to warn you about the headlines you'll see tomorrow. Silver crashes, the bubble bursts, investors flee commodities. The media loves a crash. It gets clicks. They'll ignore the fact that silver's still up massive amounts for the month. They'll focus on the one red day. Don't let the headlines dictate your emotions, man. The media doesn't know about the arbitrage. They don't know about the GSIP flush. They're reporting the price, not the mechanics. You understand the mechanics. You know that this was a sell the news event triggered by the Bank of America report. It was a tactical flush, not a strategic failure. So the chart's ugly, but the structure's safe. The support's holding. The indicators are resetting. What do you do now? Do you buy the dip? Do you sell the bounce? Do you hold through the pain? Now let's revisit the Bank of America target, $300. Today, looking at $28, a number feels like a joke, feels impossible. But you got a separate timing from destination. Bank of America didn't say silver would be $300 on Wednesday. They said the fundamentals support $300 in this cycle. Did the fundamentals change today? Did the solar panels stop needing silver? Nope. Did the U.S. debt stop growing? Nope. Did the mines find more silver? Nope. The math that gets us to $300 is still valid. Inflation plus scarcity plus monetary reset equals triple digits. Today's price drop was a sentiment event. It was about emotions, not math. The math inevitably wins, but the math takes time. If you bought silver because you believed in the $300 thesis, a $2 drop shouldn't scare you. It's a 0.6% pullback on the road to a 400% gain. Keep your eyes on the horizon, not the pothole. However, if you're sitting on cash, if you missed the breakout at $20, this crash is your second chance. It's the market giving you a mulligan. We're back in the buy zone. Any price between $25 and $28 is a gift. You're buying a breakout asset that's retesting support. This is the lowest risk entry point you'll get. Stop waiting for $15, dude. $15 is gone. The new floor is higher. Recognize the opportunity in the crisis. While everyone else is panic selling, you should be panic buying the discount. So here's the verdict on the trap. Bank of America issued a report to create liquidity. They used the retail excitement to offload some of their position or to reset their hedges. It was a cynical, ruthless move, but it doesn't change the truth. The truth is that silver is the most undervalued asset in human history. The truth is that the East is draining the West. The truth is that the price is heading higher, regardless of what happens on a random Wednesday in January. You've survived this shakeout. You're still standing. Don't let them steal your conviction. Don't let them steal your silver. The path to $300 is not a straight line. It's a war. And today, we took some shrapnel, but we're still marching forward. Hold the line, watch the $25 level, and remember why you started stacking in the first place.